Howdy, Jacob here. Today I'm looking at Enbridge, company 48 of our dividend yield stock screener. So it's an oil, gas, and consumable fuels industry, 74 billion market cap, 123 billion enterprise value, good amount of net debt on the company, very low return on invested capital. The money that gets reinvested does not get reinvested at a high rate of return. 7.7% dividend yield, so looks very attractive right now. But if we start looking at the debt, look at the cash flow, we might see a different story. 53 billion, and it's just increased quite a bit. Was 20 billion about 10 years ago, and now it's 53 billion. So over double in debt. They're getting to it looks like their capital expenditures have gone down almost, and their cash from operations have gone up. So that's good to see. But is this long term? Is this going to last? I'm not entirely confident without digging more into it, but we have to do a high level review before even looking at it. And all I can see is they're spending about a little over 5 billion in on their dividends, and they can't afford that at all. The last rolling 12 months is the only time that they could afford that. Otherwise, that's why they're going into debt. So it's really easy. I mean, a lot of companies are similar in this that, you can review companies a lot quicker once you've reviewed even just 10 or 20 that look similar. You can start clicking like, hey, why did the debt go from 20 billion to 53 billion? Well, they're trying to fund their dividends, which they can't afford through their free cash flow, so they're going into debt to pay for some of that. So that's not super attractive from my end, but I think we can start making some assumptions here. This looks plus 24%, plus 5% revenue growth, minus 24%, plus 5, plus 34, minus 1. I might do 0. we'll do we'll do 2% revenue growth. I mean, it went from 30 in the most recent rolling 12. We're looking at 33 billion. So it's really flat. I mean, I might do 1%, and it's probably going to be growing at 0% in 7 years from now. So I think even if it grows low single digits in the most recent couple years, I think when we start pushing a decade, we might get into negative single digit territory on the revenue growth standpoint, which does not require any prowess to a PE. So I think those are fair assumptions. As for margins, higher on the earnings than free cash flow side. Not super. I don't like that a bunch, but let's do 7.6. Increase shares 1%. As for the dividend, they can't afford 5 billion. Can they afford 2.5? Maybe they can afford 2.5. I might cut it in a third and say how does 1.6, roughly 1.6, 1.7 billion look? I think they could definitely do that. So cutting it into thirds and saying, you know what, they're going to be paying out 1.7 roughly billion, 1.8 billion. They can likely afford that, but they definitely can't afford the 5 billion right now without just constantly going into debt over the next couple of years likely, and that's not something I think is the most realistic. So for me, both on the dividend side, they're going to cut it into cut it 66%. I think for that, we're going to be looking at still a 2.6 nearly percent dividend yield, which is pretty attractive, I guess, still. But there's other companies out there right now that aren't going into debt to pay for their dividend, and so if I were somebody who was very reliable on the dividend for retirement purposes or whatnot, this kind of thing would not be turning me on a whole lot because their debt has been increased so much over the last 10 years, and the dividend payout is greater than the free cash flow that they earn year over year. So for me, I mean, it's always something I always like to have companies on the list, even if I don't really like them, because sometimes they can get so demolished by the general public that it's a screaming deal. But for me right now, I'm definitely waiting. I'm not even doing touching research on the stock until it gets cut by nearly three quarters. So thank you, and I hope you have a good rest of the day.